There's a massive shift happening in the gold market right now, and almost nobody is talking about it. While Western investors are dumping gold at record levels, China is doing the exact opposite. And this isn't just a small difference in opinion. This is a full-scale divergence between East and West that could define the next major move in gold prices. Because here's what just happened. In March 2026, global gold ETFs saw one of the biggest shocks in years. Western investors, especially in North America, pulled out around $13 billion in a single month. That's not just heavy selling, that's panic-level liquidation. In fact, it was the largest monthly outflow ever recorded for gold ETFs. At the same time, Europe followed with additional outflows, as rising yields and currency pressure made gold less attractive in the short term. So naturally, you would expect gold prices to collapse even further. And they did fall sharply, nearly 12% in March, marking one of the worst monthly drops since the 2008 financial crisis. But here's where the story completely changes. Because while the West was selling aggressively, Asia, led by China, was buying. And buying hard. In fact, during that same period, Asia recorded $14 billion in inflows in Q1 2026, the strongest quarter ever. China alone contributed roughly $8 billion of that. And in January, Chinese gold ETFs saw RMB 44 billion in inflows, one of the strongest starts to any year on record. Let that sink in for a moment. While billions were flowing out of gold in the West, billions were flowing into gold in the East. And this is exactly why gold didn't collapse further. Because every time the price dropped, there was a buyer ready on the other side. And that buyer was China. Now this creates a very important question. Is this just a temporary reaction? Or is this a signal that something much bigger is happening? Because when you zoom out, this isn't just about one bad month or one good quarter. This is about a structural shift in how gold is being bought and who is buying it. To understand how big this shift really is, you have to go back just 1 year. In 2025, gold ETFs experienced the strongest year in history, $89 billion in inflows globally. Assets under management surged to around $559 billion. Total holdings jumped to over 4,000 tons. And most of that demand came from the West. North America alone dominated flows with over $50 billion in inflows. So the narrative was simple back then. Western institutions were driving the gold rally. But in 2026, that narrative is starting to break. Because now, the West is stepping back, taking profits, reacting to interest rates, watching the dollar. While the East is stepping in, buying strategically, absorbing volatility, and building positions quietly. And that's where things get really interesting. Because when markets transition from weak hands to strong hands, that's often when bottoms are formed. So the real question is no longer, why is gold falling? The real question is, who is buying and why? And once you understand that, you start to see a very different picture of where gold could be heading next. To understand why China is buying gold so aggressively right now, you have to understand one thing. This is not short-term trading. This is long-term strategy. Because while Western investors often react to interest rates, inflation data, and short-term price movements, China is playing a completely different game. Let's break it down. First, currency pressure. The Chinese yuan has been facing ongoing pressure against the US dollar. And whenever a currency weakens or becomes unstable, investors start looking for protection. And historically, one of the most trusted forms of protection is gold. Because gold is not tied to any single government. It doesn't depend on interest rates. And most importantly, it holds value when currencies lose trust. That's why Chinese investors, both institutional and retail, have been moving money into gold ETFs. Not just to profit, but to protect purchasing power. Now here's where it gets even more interesting. This isn't just retail behavior. China's broader financial system is also shifting. Local equity markets have shown weakness. The real estate sector has been under pressure. And traditional investment options are becoming less attractive. So where does that capital go? It moves into alternatives. And gold ETFs are one of the easiest, most liquid ways to gain exposure. That's why we're seeing massive inflows into major Chinese gold ETFs, with funds like Huan and Guotai leading the way earlier this year. But there's another layer to this, and it's even bigger. De-dollarization. Over the past few years, China, along with several other countries, has been slowly reducing reliance on the US dollar. And gold plays a key role in that strategy. Because gold is globally accepted, sanction-resistant, and independent of Western financial systems. So when China accumulates gold, whether through central bank reserves or ETFs, it's not just an investment decision, it's a geopolitical strategy. And that's why this buying is so important, because it's consistent, it's calculated, and it's happening regardless of short-term price movements. Now let's connect this back to silver, because while China is aggressively accumulating gold, silver is being influenced by a slightly different dynamic. Unlike gold, silver is not just a monetary metal, it's also an industrial metal. That means its price is heavily influenced by solar panel production, electric vehicle demand, semiconductor manufacturing, and right now, those sectors are growing rapidly, especially in Asia. China, in particular, is one of the largest consumers of silver for industrial use. So while gold is being bought as a financial hedge, silver is being driven by a combination of economic activity, industrial demand, and delayed investment flows, which explains why silver has been more volatile. It reacts not just to fear, but also to growth expectations. And that creates a very interesting setup. Because if China's economy stabilizes or accelerates, silver demand could surge very quickly. And if that happens while gold is already being accumulated, you could see both metals rising together, but with silver potentially moving faster. So now you have two parallel forces, gold being accumulated for protection and strategy, silver building demand through industry and future growth. And when both of those align, that's when major moves in the precious metals market usually begin. But here's the problem. While China is building positions quietly, the West is doing something completely different. And what they're doing next could either delay this rally or accelerate it dramatically. Now let's shift to the other side of the story. Because while China is buying aggressively, the West is doing the exact opposite. And to understand this divergence, you need to understand how Western investors think. Because in the US and Europe, gold is not always treated as a long-term strategic asset. Instead, it's often treated as a trade, a position that depends on interest rates, dollar strength, market liquidity, and short-term risk sentiment. So when conditions change, money moves fast. And that's exactly what happened in March 2026. After a massive rally in 2025, where gold ETFs saw record inflows of $89 billion globally, many Western investors were sitting on significant profits. So when gold prices started to pull back, they didn't wait, they sold. And not just small amounts. In North America alone, investors pulled out around $13 billion in a single month, the largest outflow ever recorded. That wasn't a gradual shift, that was a sharp exit. And it was driven by multiple factors all hitting at once. First, interest rates. As expectations around the Federal Reserve policy shifted, yields remained relatively elevated. And when interest rates are high, gold becomes less attractive. Because gold doesn't pay interest. So investors start comparing. Why hold gold when I can earn yield elsewhere? That's what we call opportunity cost, and it's one of the biggest drivers of gold flows in the West. Second, the US dollar. A stronger dollar puts pressure on gold prices, because gold is priced in dollars globally. So when the dollar rises, gold tends to fall, or at least struggle. And during this period, dollar strength added another layer of pressure. Third, systematic and algorithmic selling. This is something most people don't talk about. Large funds often use models, CTAs, trend-following systems, algorithmic strategies, that automatically sell when certain technical levels break. So when gold started dropping, these systems accelerated the move, turning a correction into a sharper sell-off. And then there's geopolitical positioning. Events like recent military tensions and global uncertainty initially pushed gold higher. But once those fears stabilized even slightly, short-term traders took profits quickly. So when you combine all of this, profit-taking, high interest rates, strong dollar, algorithmic selling, you get exactly what we saw. A massive wave of Western outflows. Now let's connect this to silver. Because silver reacts even more aggressively to these kinds of conditions. Unlike gold, silver is smaller, more volatile, and more sensitive to liquidity. So when Western investors start selling, silver doesn't just decline, it drops faster. That's why during this same period, silver saw sharper swings. It struggled to hold key support levels, and it underperformed gold significantly. This is also where futures markets, like COMEX, come into play. Silver is heavily traded in futures markets, which means leverage is involved. And when prices start falling, liquidations can trigger even bigger moves. So while gold was being partially supported by Eastern buying, silver didn't have the same level of immediate support. And that's why the gap between gold and silver widened. But here's the key insight. Western investors are reacting to conditions. Eastern investors are acting on strategy. And that difference is exactly what creates major turning points in markets. Because when fast money exits and strong hands step in, that's often when markets stop falling. So now the stage is set. The West has sold aggressively. China has been buying steadily. Silver is lagging behind. Which leads to the most important question of all. Has the selling already peaked? And is the bottom already forming? So now we arrive at the most critical part of this entire story. Is the bottom already in for gold and potentially silver as well? Because when you look at everything that just happened, a very specific pattern starts to appear. And it's a pattern we've seen before. Let's break it down. Gold dropped nearly 12% in March 2026, one of the sharpest monthly declines in years. At the same time, Western investors exited aggressively. ETF outflows hit record levels. Momentum turned negative. Sentiment shifted quickly. On the surface, that looks bearish. But under the surface, something very different was happening. Because despite all that selling, gold did not collapse. It didn't break down completely. It didn't enter a free fall. Instead, it stabilized. And the reason is simple. Every time price dropped, buyers stepped in. And those buyers were not short-term traders. They were Asian investors, Chinese institutions, strategic accumulators. This is what's known in markets as absorption, when strong hands absorb selling from weak hands. And historically, this is one of the most important signals of a potential bottom. Now here's where things get even more interesting. If you go back to previous major events, like the 2008 financial crisis, the 2020 COVID crash, you'll notice a similar pattern. First, sharp sell-off, panic-driven outflows, weak hands exit. Then, strong hands step in. ETF flows stabilize. Prices begin to recover over the following months. In many of those cases, gold ETF flows flipped from negative to strongly positive within months, and prices followed. Now look at what's happening right now. Despite March's massive outflows, Q1 2026 still ended positive overall. Total holdings increased by around 62 tons. Assets under management rose to about $606 billion. This marked the 7th consecutive quarter of inflows. That's not a collapsing market. That's a market under transition. Now let's bring silver back into the picture. Because silver plays a very specific role at this stage. When gold stabilizes after a correction, silver often lags behind at first. It remains volatile. It struggles to gain momentum. It looks weak compared to gold. But then, once confidence returns, silver tends to move faster and more aggressively. This is because it's a smaller market, it has both monetary and industrial demand, and it attracts momentum traders quickly. That's why many major rallies in precious metals follow a pattern. Gold bottoms first, silver lags, then silver explodes upward. And right now, we are potentially in that transition phase. Gold is being supported, selling pressure is being absorbed. Silver is still lagging, but building energy. Which brings us back to the core idea of this entire video. Smart money is moving east. And that smart money is not chasing price, it's accumulating during weakness. So when you combine everything, record Western selling, strong Eastern buying, gold stabilizing after a sharp drop, silver lagging but structurally supported, you start to see a very compelling setup. Not confirmation, but a strong possibility that the bottom is already forming, or very close. But there's still one final piece missing, because for a true rally to begin, something has to change in the West. And when that shift happens, it could trigger the next major move in both gold and silver. So here's where everything comes together. Because up to this point, the story has been clear. The West sold aggressively. China and Asia bought the dip. Gold stabilized instead of collapsing. Silver lagged behind, building pressure. But for the next major move to begin, one thing needs to happen. The West needs to come back. Because right now, the market is being supported by Eastern buying. But a true breakout, the kind that sends gold to new highs and pulls silver up aggressively, usually requires global participation. And this is where things could shift very quickly. Let's look at what could bring Western investors back into gold. First, interest rate cuts. If expectations start shifting toward lower rates, the opportunity cost of holding gold drops. Suddenly, gold becomes more attractive again. Second, a weaker US dollar. If the dollar starts losing strength, gold gets a natural boost, and that alone can reverse ETF outflows. Third, renewed market uncertainty. Any spike in geopolitical tension, financial instability, stock market volatility can trigger safe haven demand again. And when that happens, Western investors don't ease in slowly, they move fast. And when they return to gold ETFs, that's when flows can flip dramatically. Now think about this setup. Eastern investors have already been accumulating. Gold has already absorbed heavy selling. Silver is still lagging and undervalued. So if Western money starts flowing back in, you don't just get a recovery, you get momentum. And that momentum can push gold toward new highs and silver into an explosive catch-up rally. Because silver doesn't just follow gold, it amplifies the move. Now this brings us back to the core question we asked earlier. Is the bottom already in? And based on everything we've seen, the answer is not confirmed. But the conditions are lining up. Strong hands have been buying. Weak hands have already sold. The market has stabilized after a sharp drop. And global flows are starting to rebalance. This is exactly the kind of environment where bottoms are formed. Quietly, without headlines, without confirmation. And only in hindsight does it become obvious. So right now, we are at a very important moment, a transition phase, where the market is deciding its next direction. And if the West returns while the East continues buying, this could be the beginning of the next major cycle in gold and silver. Before moving forward, make sure to subscribe to the channel and like the video if you want to stay ahead of these major market shifts. Because in markets like this, the biggest opportunities come when most people are still uncertain. And right now, this is one of those moments.